Hello everybody and welcome to the Trading Setup channel. My name is Niku and on this channel we explore the world of trading. There are hundreds of patterns in trading, but if you are new to this, you have probably faced the same issue. The setup looks perfect, everything lines up, but the market still goes the other way. Why does this happen? It's because 90% of patterns are just visual illusions with no real logic behind them. It's not the textbook looking patterns that work, but the ones that reflect real trader behavior. Today, I'll show you 5 reversal patterns that actually make sense. These setups help you spot the moment when the crowd still believes in the old trend, while the market is already preparing to move in a new direction. Once you understand the principle, you will stop searching for the perfect formation and start to understand the market from the inside out. Before we jump into the practical side, I want you to have access to a resource where I've collected the most important information on this topic. This is my open resource where I post working setups, real examples of trades, results from my students, and detailed analysis frameworks. In the pinned posts, you will find guides on indicator setups, risk management techniques, and step-by-step manuals for the martingale system in a way that helps you build your process consciously instead of guessing. This is not a course or an ad, just a knowledge base that I constantly update. Go to the link in the description, download the materials you need, and do not forget to activate the promo code. It opens extra sections and the latest updates. Now, let's get to the main part and discuss those candle patterns. First pattern is the double top. This is the simplest and one of the most reliable setups, especially on higher time frames. The idea is that the market tests the same level twice but cannot break through it. Each push higher gets weaker and each pullback gets deeper. Psychologically, this is where buyers start to lose momentum. After the second touch and a break below the neckline, which is the zone where the market tried to hold, a reversal begins. The most important rule: do not rush. The pattern is only confirmed when a candle closes below the neckline. If price returns to this level and it becomes a resistance, that is your confirmation. Our second pattern is the double bottom. This is the exact opposite of the previous one, but the logic remains the same. The market tests an area twice where sellers cannot push the price lower anymore. Each bounce higher gets longer and each move down gets shorter. When price breaks above the neckline and stays there, the reversal phase starts. The key thing to remember: do not try to catch the bottom. Wait for a breakout confirmation. Most mistakes happen because traders jump in too early, hoping for a reversal instead of waiting for proof. The third pattern is head and shoulders. This is a bit more complex but incredibly powerful. It does not form in just one session. It shows a real shift in the balance between buyers and sellers. The left shoulder is the first push and an attempt to keep the trend going. The head is the top, after which the market first starts to show weakness. The right shoulder is the last attempt to continue the trend, but it is shorter and weaker. After breaking through the neckline, price moves in the opposite direction. Often the market will retest this level, and that is the best entry point. For downwards trends, the pattern flips, the inverse head and shoulders. It works exactly the same, but for bullish moves. Our fourth pattern, engulfing. This one is especially helpful on lower time frames when you need to spot the reversal quickly. It shows up when one candle completely engulfs the previous one, meaning its body covers the whole range of the last candle. For example, in an uptrend, a strong bearish candle appears and wipes out the previous structure. This shows that big volume is entering against the old trend. The main thing is not to focus on the color of the candles, but on where they form. An engulfing pattern in the middle of the range is just noise, but if it shows up on the edges of a trend at extremes, that's a strong reversal sign. Last but not least, the hammer, and its opposite, the hanging man. These are single candles, but their power is in context. After a long drop, if you see a candle with a long lower wick and a small body, it means sellers are losing control. Price dipped but quickly came back up, which signals that big players started buying up in volume. The opposite, the hanging man, appears after a rally. A candle with a long upper wick signals that buyers are running out of steam. You always want to wait for a confirmation candle to make sure that the reversal is actually starting. If you want to go deeper into these patterns and many other aspects of the market, I invite you to my trading community. There, we go through each pattern live on real charts with explanations of why and where it works. This is not a show and forget format. It is daily practice where members learn to see the market with a clear mind. To join, just message me directly. I pick each participant myself to keep the atmosphere and level high. Access is open for now, but the group is limited. You can find my contact in the description below. If you are interested in systematic trading without guesswork or chaos, subscribe to the channel. In upcoming videos, I will break down how to combine these patterns with indicators and why seeing the market structure is more important than just looking for entry points. I'll see you guys in the next session, and may every analysis you make be a conscious one.